Hey there, everyone. Thanks for staying with us here on CBS News. I'm Errol Barnett.
And I'm Lana Zach. We are awaiting the Federal Reserve's latest decision on interest rates.
That's right. Now, the Fed is widely expected to leave rates unchanged for now, as we're starting to see signs that inflation may be cooling.
The Consumer Price Index eased to an annual rate of 4% last month. That's the slowest pace for inflation since 2021.
So what's about to happen? Joining us now here in Studio 57 is Jill Schlesinger and Javier David. Jill is a CBS News business analyst. Javier is a CBS News contributor and managing editor for business and markets at Axios. It's a mouthful. A warm welcome to you both. The expectation is things will stay the same, but that doesn't mean that the world is unchanged. Jill, what will we read out of an unchanged rate hike today?
A deep breath and Fed officials being able to say, OK, we got to see how this is all going to filter through the economy. 10 consecutive rate hikes. We've seen interest rates rise from 0% to a range of 5 to 5.25%. A very fast and aggressive rate hike campaign.
Yeah.
Rates now at a 16-year high. But there is evidence, as we said in the beginning of this segment, that inflation's coming down, so that could mean that the Fed wants to wait and see how these higher rates are filtering through the economy. And I think that's really important because a lot of people have said it's hard to get credit, it's hard to borrow money now, it's hard to buy a house now. And I think the Fed is sensitive to that and wants to see whether or not there are continued measures that we can see in terms of progress on inflation, at the same time not stifling growth to basically going into a recession.
And on that point, Jill, I think that there has also been this uncertainty that we've all felt, whether you're watching the markets and you're watching these numbers, or you're just trying to figure out whether or not you can afford a new home loan. Javier, help our viewers understand what all the factors are that the Fed is looking at as they're making this decision.
Yeah, the first is just kind of like the headline prices, all of the things that make inflation and running hot. Like services has been very, very important, and that's critical to see. That's actually still pretty elevated, even though like we've gotten pretty encouraging data this week.
I want to pause you for just a second to bring our viewers up to speed. We just found out that, in fact, your predictions were correct. There is no interest rate hike this time, the first time after 10 consecutive hikes. Javier, please continue.
So a lot's been happening on the inflation front. That's been encouraging. So you've had CPI and PPI this week, all showing that prices are moderating. Inflation overall has been really stubbornly sticky in a way that the Fed would probably been well within their rights to continue their hike. But as Jill said, I think there's reason to pause. Like credit is tightening. People are having a difficult time getting loans. As we saw the strains of the banking sector this spring, interest rate risk is real. It's a real problem for banks that have treasury debt on their books where they bought it at a lower interest rate and now interest rates are significantly higher. There are all of these factors playing in. It seems like the right time to just say, let's take a break, let's see where things stand, and there's nothing preventing them from hiking again when they meet later on.
Well, Jill, I was about to ask you about that because while we have this news now that the Fed is taking this pause on rate hikes, it doesn't necessarily mean later this summer they may go back to what we've seen over the past, 11 to 15 months. The lag effect, though, from one decision to hitting all of our pocketbooks and hitting the market is a couple of months long. So how much do you feel that that lag should be factored into what's happening?
Well, I mean, the Fed understands that certain rates move very quickly, like credit card rates, which are at their highest level in many years, and they've always been high, but now they went higher. So anything that's a short-term rate that is linked to a short-term rate is going to move very quickly when you see rate hikes. Yeah. But I do think, I'm just looking at the actual statement, and it's basically the Fed says tighter credit conditions for households and businesses are likely to weigh on economic activity, hiring, and inflation. So they believe that these higher rates are already weighing on the economy. The thing that it hasn't really hurt so desperately is the labor market, which has been resilient. And in some respects, the resilience of the labor market gives the Fed a lot of room to keep rates higher for longer. You're right. They certainly could raise rates at that next meeting in 6 weeks at the end of July. But I would ask the Fed officials this. What do we really think is going to change in 6 weeks? Don't you kind of have all the information you need? Don't forget, this is a Federal Reserve that got a very late start in this rate hike campaign. That's why they had to move so aggressively. There were many calls for people who are economists who say, look, they should have started in the fall of 2021. It was obvious inflation was taking off. And because they got a late start, they had to go really fast and really high. And I think that this is the impact that we are seeing, these tighter credit conditions. And it puts a pressure on a lot of households when you see credit and the difficulty of attaining new credit, but also servicing those old credit card debts and those loans that are linked to short-term rates.
So, Jill, I want to stick with you for just a second on this point because, as you mentioned, the Fed was very slow and received some criticism for not addressing that 0% interest rate in the beginning and all the inflation that we subsequently saw during the pandemic and coming out of that. How will this affect the possibility for a recession? Because there are still some economists that say that that's still possible, that this might be the soft landing, but this might not be the end of it.
It may not be. I mean, I guess that I look at the data and I don't see recession. I don't think anyone can look at where we are. You cannot have an economy producing 339,000 jobs in a month, 341,000 on average over the course of the last 12 months. It's hard to see an economy that produces more than 300,000 jobs a month and call that a recession. Things are slowing down. They're not slowing down by as much as everyone had predicted. And this is a very unloved economy. There are so many people saying that it is recession, recession, recession. Right. It is a possibility. On the other hand, if you're at home, who cares what you call it? You either have a job or you don't have a job. You can pay your bills or you can't pay your bills. Things are slowing down. And I think that there's more concern among households about the future. And the reality is you don't have control over the future. So all you can do right now is say, hey, if I have a job, got to really work hard and pay down that high interest debt. I got to try to save my 6 to 12 months of my living expenses in the bank. I'm going to keep putting money into my retirement account. Those are the things you can control.
And I like where you're going with the thinking of what people can do now today with that information, Javier. On that point, there are some folks who are awaiting big ticket items, whether it's a car loan or a home loan, and maybe they've held off until they know more from the Fed. If we take Jill's most optimistic perspective, which is they've taken this pause, and maybe that means a pause again later in the summer, how should people factor that into their big ticket purchases that they may put on the line?
A lot of people have front-loaded big ticket stuff. We did that last year when everybody was in lockdown, or everyone first emerged from lockdown. Everyone was buying. We were working from home. We bought like new sofas. We did new desks. We did washing machines.
A lot of shop therapy.
A lot of shopping. Used cars are still actually, interestingly, still pretty expensive.
It was interesting that's one of the indicators that still just has not come down.
And the other one that we don't talk enough about, and from my taste, is shelter costs. We think of an isolation, particularly depending on where you live. Particularly here in New York City, you're like, oh my God, I need an apartment, but like I can't find anything that's affordable. This is a really big problem, and it's very much inflationary. It's at least a third of what constitutes this CPI. And these prices are incredibly sticky, and they're not going anywhere.
You know what's interesting about that, though? The shelter number confounds me. And here's why. Because the way the Labor Department looks at shelter is, of course, we can look at rents. That's the easiest way. But let's say Javier and I are married, we own a home, and we refied during the real low interest rates. And now we've got an interest rate that's 3% for 30 years, right? But when the Labor Department comes in and looks at our house, they say, hey, we don't look at what you're paying. We look at what it would cost you to rent that house in the free market today. Wow. That's not my experience in the lived economy. So the shelter number, which did see an 8% increase year over year, is a somewhat distorted number. But I agree it has a real impact. And certainly the Fed cares about this because service side of the economy, 2/3 of the economy, is really moving based on some of the services that we need, like rent, like transportation, and these things have not come down significantly yet.
Yeah, and it also bears mentioning that we talk also about mortgages being high, 7%. That's a barrier for people that are renting that actually want to buy and like, I can't afford to buy.
And it's not just the mortgage rates,
right,
but that we've also seen that the price of homes hasn't come down at the same level that mortgage rates are increasing.
And that has a spillover effect on renting supply because people that would be buying at this point are not because it's just cost prohibitive. And now they're like, the sort of flow out of apartments into housing is clogged because people that are holding on to these apartments, it's just cheaper for them to stay where they are.
All very important information. We appreciate you guys joining us here at the big desk. Look, we've
Yeah.
got space. We've got room.
Come anytime.
Jill Schlesinger and Javier David, thanks for being here, guys.